I am Jim Grant. I founded Grant's Interest Rate Observer almost 35 years ago. And I am glad that you are interested enough in what we do to be listening. And I'm with the deputy editor of Grant's named Evan Lorenz. Evan, good morning.
Good morning.
We thought that we would begin what we hope will be a series of podcasts by telling you about who we are, what we do, why we do it, and how we go about doing it. So I will begin with the archaeological material, Evan. 30-odd years ago, in fact, 35 years ago, I decided that what the world needed was something else to read. Now, this was a rash assumption on my part. The world seems to have more than enough. Certainly it does. It did then. It certainly has more now. But I thought that what the world specifically needed was a publication every 2 weeks that would comb through the signs and portents of monetary policy, central banking, and interest rates, some of the most important prices in the world of finance. And if not predict every squiggle and movement, at least help my readers understand more than they otherwise would the world of credit and of bonds and other interest rate sensitive securities. That was the plan. And I thought further that we at Grant's, then it was myself and my part-time secretary named Liz Haldigan. I thought that we would highlight both the best things being done on Wall Street and also the worst. We would have long ideas, we would have short ideas, we would have the best writing and the funniest cartoon. That was the plan. And to some degree, I think I can say, as the disinterested and purely objective proprietor of Grant's, that we have achieved that. And I know, Evan, as a deputy editor of Grant's, you might agree with some of that. Just nod your assent.
Yeah.
So what do we do for a living? I'm going to ask my right-hand man, Evan, to tell us and remind me how we go about gathering up ideas and presenting them to the world. Evan, how do you work it?
We publish every 2 weeks on a Tuesday, and we release to the market after the market close every Wednesday at 4 o'clock. On Wednesday morning, we come in with a fresh slate and start looking for ideas. And we look for ideas just about like every other investor. We comb Bloomberg through our screens. We go through the news to see if there's any interesting headlines that pick our interest. Or we talk to Grant's readers or other investors to see if there's something interesting happening in the market that's not being well covered. After that, we start digging in and calling companies, reading transcripts, calling suppliers, talking to other investors in a company, calling up analysts who cover the stock, and try to form a 360-degree mosaic to understand what exactly are the issues, what has been priced into the market, is there an interesting story that has not yet been expressed in the share price of the stock or the bond that we're actually working on. Yeah. If we think that at the end of 2 weeks of work that the story has merit and that there is something interesting to do for our readers, we write that up into a memo which I then hand to Jim, and Jim makes sound much, much better at the end product. We publish and then we begin again.
Yeah, that we do. You know, the great topic that I have been struggling with over the course of these almost 3.5 decades is the great cosmic topic of the future. The fathomless future. A closed book is the future, and yet it is all that investors really cared about. You know, they have to know what's going to happen, because that's what markets are about. What is going to happen, what has happened, is of interest to historians, and I think to a degree to the thoughtful investor, but it's the future that counts, and yet we can't know the future. Evan, how do you deal with this paradox? Well, exactly. I'm gonna exercise my rights as a proprietor, and to say that what I think we do is first and foremost to acknowledge that we don't know the future, and then acknowledging that fact. Not everyone regards that as so very helpful, but acknowledging that great truth, we observe in the present how the world is, as it were, handicapping the future, right? We can't know what's going to happen under the ever so interesting and already flummoxing administration of Donald J. Trump, but we can at least see how the world is set up. This is one of the great phrases in investing. What's the setup? So take the specific moment. So here it is, late in January of 2017, is it, Evan?
Yes.
Okay. And the Trump administration has been in business for about 4 or 5 days. And The New York Times on Monday led the paper with what it called a news analysis, not the news, but a news analysis, which proceeded to hang crepe over the administration of Donald Trump as if it had already failed. And Trump, here it was Trump scratching around for office supplies. It hadn't even started, and they were saying that he was going to fail. Well, he might fail. So we can observe that the sentiment in the press is almost universally negative. We can observe that, however, paradoxically, the stock market is very high, not necessarily very, very high, except that we have to reserve that particular description for perhaps later in the cycle, but it's at, 20 times trailing earnings in the S&P. And when Reagan was coming in, it was at 9 times. So we observe that the world is setting up seemingly for the success of Donald Trump, whereas in the past it had set up for the non-success, indeed perhaps for the failure of what president that turned out to be pretty successful. So that's what I mean by making some compromise with the present and the future. The world wants to know, our readers want to know the future. We don't know the future, but we can observe and we can, as they say on Wall Street, fade a consensus. Now, Evan, tell our listeners how we go about fading a consensus of opinion, a hard-formed phalanx of people insisting that one outcome is the most likely.
The wonderful thing about the markets is you get a price every day and you can see what is priced into a security. You could also do a little footwork and find out what people believe and find out what the consensus is. Then you can ask yourself, how could that be wrong? Just 2 weeks ago, the Wall Street Journal published a headline, "Investors bolt Mexico as peso enters freefall." It's clear that people wanted out of Mexico because Trump is going to build a big, beautiful wall, because Trump is going to put in place a big border tax, and it seemed like investors had begun to price that in. But in that rush to leave, an unfavored market, sometimes a lot of value is left behind, and sometimes events don't work out as people imagine. Perhaps Trump will build a wall, maybe he won't. Maybe he will put a border tax in. Maybe a border tax is already priced into stocks, or more than priced into stocks.
Or into the peso.
And by doing a little legwork and kind of digging into the various securities and issues, you could sometimes, while not predict the future, find stocks that have already discounted all the bad news and then some. And if you buy those securities, if the worst comes to pass, you'll do okay. If anything surprises to the upside, you'll do more than okay.
Well, this particular approach reminds me of the work we did, and especially my then associate Dan Gertner did in the mid-aughts, starting about 2005 and 6. We began to comb through the documents pertaining to these very fancy mortgage contraptions, collateralized mortgage obligations, and other such instruments that packaged up securities and purportedly presented investors with a very sound risk-reward proposition. Because these mortgages, after all, were collateralized by American single-family houses, which houses never in the history of recorded finance lost their value all at the same time. That was a known, it seemed. But as we looked through these structures with the help of our readers, what we could see is that they were priced for a more or less perfect outcome. They were selling at 100 cents on the dollar, sometimes 101 cents on the dollar. And if everything went right, the investor might get back 101 cents or perhaps 100 cents plus interest. That was the upside. But if, as we thought, and indeed as turned out to be the case, if there was something structurally wrong with the securities, and if there were a big, fat, ugly bubble, to borrow from the phraseology of our president, if that were the case, then these securities could deliver not 100 cents on the dollar, but maybe 30, 40, 50 cents, or much less than those figures. We couldn't anticipate the great financial crisis. We saw some of it coming, but mostly we could see that in these securities there was a most asymmetric, as they say, a most asymmetric risk-reward proposition, and that because the consensus was so hardened in an optimistic vein concerning housing, that we were kind of, as Lloyd Blankfein said facetiously, we were kind of doing God's work by investigating the alternatives. Yeah.
At the same time, Grants also proposed another trade that worked out spectacularly well but got a little less press. In the mid-aughts, most credit investors began pricing in convergence in the European sovereign bonds. The idea that because Greece, Spain, Italy, and Germany were all part of the euro, that the yields on the sovereign bonds for each of these countries should converge to the yield of the Bund. Grants at the time actually proposed that credit risk in these countries still existed. Things could go wrong, and suggested buying CDS on Greek bonds for a handful of basis points.
CDS meaning?
Credit default swaps.
Yes.
Contracts that pay if things go bad for a sovereign issuer. And those contracts paid off quite handsomely for investors who actually executed that trade.
Yeah. Well, we try to be even-handedly opportunistic, meaning seeking out opportunity in excess to the upside and seeking it out in excess to the downside. That is to say, trying our best to exploit extremes, unreasoned extremes, both of optimism and pessimism. And sometimes we do that, sometimes we fail at that. The difficulty mostly is that the market is not at an extreme, right? It's neither unreasonably rich nor fantastically value-laden. So you have to take a much more marginal approach to life as in finance. You know, most Tuesdays are like most Wednesdays, which are neither crisis-racked nor manic to the upside. Since you have been here, Evan, it's been well nigh 5 years, I think.
A little over.
Yeah. What has been, in your recollection at the moment, the most interesting and gratifying story you've worked on?
I think the most interesting one for me, because we were able to mine it for multiple ideas, was because of the existence of Dodd-Frank, the regulator for thrift and saving banks was going to disappear. As a result, a lot of thrifts were converting their charter to commercial banks. And when they convert, they were converting at prices well below book, sometimes at a 30 to 40% discount. None of these banks were very large. They had market caps between like 50 million to a couple hundred million. But these were banks that had rock-solid balance sheets, had come through the financial crisis with flying colors. And while they might have been expensive on a price-to-earnings basis, they were never really run for a profit motive. And you had this set change that was coming in the regulations that you knew was coming, and you saw this coming wave of banks that had applied to flip their charters, and when they flipped their charters, the market priced them as if they would always be entities that were not run for commercial profit. However, a magical thing happens when you tell a CEO, okay, you're going to make a lot of money if this bank, if your company starts earning a lot of money. And these thrifts did one of two things. They either started generating a profit after years of being run for the benefit of their mutual depositors, or they got bought out by larger banks at a premium to book. And it was a very rich vein of ideas that was easy to find, that the market completely ignored, but that there was some certainty because of the regulatory change that had already been put into place. And you could actually find numerous stocks that you could buy because of this.
Wow. Well, tell us also about Valiant Pharmaceuticals. That was one of your shining moments. We got this idea. I heard this idea from Jim Chanos, a renowned short seller. I mentioned it, and I came in the office. Evan, take a look at VRX. That was a ticker. And what did you find?
Valiant was an interesting company.
It is. It still
is. It's still extant. It still has a share price above $10 right now. Valiant Pharmaceuticals was a company where, looking at the share price and the expectations discounted into it, you could see that it was loved. Its shareholder roster was gold-plated and included famous investors like Rain and Quinniff. When you started looking at the numbers, though, you started scratching your head. The published figures told you very little of what the company was doing. The company put forward non-GAAP figures that looked spectacular but excluded a lot of the cost of actually doing business. The company didn't invest into its pipeline of drugs. Rather, it acquired them from the street. However, when it went to push out its non-GAAP figures, it excluded the cost of actually acquiring these drugs. If you did a little math, it looked like its organic growth was negative, and it looked like, and after doing some work and talking to people in the street, that the reason it was able to generate such good returns initially from its acquisitions was it dramatically raised prices. It was kind of a sugar rush after they made an acquisition that pushed up the earnings of acquired companies at the expense of volume. The problem in the pharmaceutical industry is patents have a finite life, usually around 10 years. So it was buying these short-lived income streams, hurting volumes, and kind of excluding the cost of actually doing this from its accounting, all the while running up an incredible amount of debt that it would have trouble servicing if it couldn't keep growing earnings. So it was on a treadmill.
At what share price did we first say this was not the thing to own and indeed the thing to short?
We set it around $145 on its way to $250
right.
before it hit 14.
Yes. Well, listeners, this speaks to another difficulty in being contrary-minded and in sometimes being, shall we say, gently, should we say, early. Sometimes one gets one's face ripped off. That is a term of art and finance. Whatever pinpoint timing is, we exhibit it rarely and by accident here at Grants. We are attentive to the fundamentals, and sometimes the fundamentals take a while to validate themselves in the marketplace or to find expression in price. If there is any one constant over the course of these almost 35 years, it is the editor's opposition. I was going to say skepticism, but complete and utter opposition to the doctrines of the Federal Reserve. That is the thread of continuity in our business, in our publication. Implacable critics we are of the idea that a central bank ought to create credit out of thin air to manipulate interest rates and thereby to improve our lives in finance and in our daily work. I think that that doctrine is on its face fanciful, and the results stemming from that doctrine, I think, have been, on balance, very harmful. So we are inveterate and rather stern critics of the Fed. I feel sometimes like the editor of the Chicago Tribune tossing verbal brickbats at the Purple Gang during the gangster era in Chicago. The gangsters would never answer you, never even take a shot at you. They just, they pretend you didn't exist. So the Fed has taken that stance towards us, but I have every confidence that as the years wear on, that our views will be vindicated and the Fed will get back to the business of sound money as opposed to a glorified kind of or a half-baked kind of central planning.
We publish every 2 weeks in a long-form journalism at a time that the market mostly digests 140 characters or less instantaneously. What do you view the value of well-thought-out and timely research in an age where all analysis is, within the second an event happens?
Oh, what a great question, Evan. The world seems to be migrating towards ever shorter and, dare I say, more superficial modes of communication and narrative. And we, I guess kind of bloody-mindedly, have stuck with what we have always done, which is to delve deep into topics. Some of our analyses run to, say, 12 double-spaced pages. That's the term paper you always hated writing in school. Some of them a bit longer, some of them shorter, but we don't shy away from depth when depth seems necessary to explore not only what we regard as the proper analysis, but also to give due weight to the contrary evidence and to try to address that evidence. I am optimistic that one of these days we will be the sole surviving purveyor of long-form journalism, and then we'll have like a monopoly, like the Fed. The government won't endorse it or protect us, but I think that we're onto something here, Evan. Mm-hmm. So, ladies and gentlemen, this is Grant's on tape. This is the sound of Grant's Interest Rate Observer. We publish every 2 weeks. We, I guess, produce about 7,500 words of finely wrought prose, a few numbers besides, some pretty pictures, and a funny cartoon. Many people think that it's very hard reading. I think that they exaggerate. I think it's actually very easy reading, and I am bold to say it's necessary reading. So we thank you, Evan and I do thank you for listening.